Right now, the world's largest asset manager is quietly repositioning trillions of dollars. Not millions, not billions, trillions, and almost nobody is talking about what that actually means. BlackRock manages over $10 trillion globally. Pension funds, retirement accounts, sovereign wealth money. When they adjust allocations, it's not random. It's calculated. And recently, their shift suggests something deeper than routine rebalancing. But here's the part that should get your attention. This isn't just about markets, it's about America's role in global finance. Because for decades, global capital flowed toward the United States almost automatically. U.S. Treasuries were the safest asset. U.S. equities were the growth engine. The dollar was the anchor of the system. Now, that assumption is being quietly tested.
Over the past few years, capital allocation trends have started to change. Exposure is being diversified. Geographic risk is being reassessed. And the idea that the U.S. is the default destination for global money is no longer unquestioned. And if that sounds abstract, let me make it personal. Your retirement account, your mortgage rate, your job market stability, your purchasing power, all of these are tied, directly or indirectly, to where global capital chooses to sit. Here's the question nobody is asking clearly. Is BlackRock preparing for short-term volatility? Or are they positioning for a structural shift in the global financial order? Because those are two very different stories. And by the end of this video, you'll understand what the data actually shows, what's normal portfolio management, what's strategic repositioning, and whether America's financial dominance is quietly evolving into something more complicated.
But before we get there, you need to understand one critical concept. Capital doesn't move loudly, it moves early. And once it moves at scale, the effects show up later, in interest rates, in asset prices, and eventually in everyday life. So the real issue isn't whether BlackRock shifted money. It's why. And more importantly, what happens next if that trend continues. Let's break it down. What makes this story interesting is not a single headline or one quarterly report. It's the direction of movement over time. When you zoom out and look at asset allocation trends across major institutions, you start to see a gradual shift. Not an exit, not a panic, a shift.
BlackRock's public filings show increasing diversification into non-U.S. assets over recent cycles. More exposure to emerging markets, more infrastructure outside North America, greater interest in commodities and real assets. At the same time, U.S. Treasury demand dynamics have changed. Foreign official holdings of U.S. Treasuries have declined from their 2014 peak, according to U.S. Treasury data. That doesn't mean collapse, but it does mean concentration risk is being reassessed. And that distinction matters, because capital rarely leaves all at once. Historically, large institutions adjust in phases. First, they rebalance, then they hedge, then they structurally reposition. By the time the public notices, the reallocation is already priced into markets. So the real question is not, is BlackRock abandoning America? That would be simplistic. The better question is this: why does the world's largest asset manager feel the need to diversify at this scale right now?
To answer that, we need to look at 3 pressure points building inside the U.S. financial system. The first is debt trajectory. Federal debt has expanded significantly over the last decade, and interest costs have risen alongside higher rates. According to the Congressional Budget Office, net interest outlays are projected to become one of the largest components of federal spending in the coming years. That changes fiscal flexibility. It limits policy options. The second pressure point is rate sensitivity. The era of near-zero interest rates masked structural imbalances. When rates normalize, capital becomes more selective. Higher yields can support the dollar in the short term, but they also raise refinancing costs. Institutions pay attention to that math very carefully. And the third pressure point is global competition. This is where it gets interesting.
Over 40% of global GDP now sits in economies outside the traditional Western bloc. Cross-border trade settlements are slowly becoming more diversified. The dollar still dominates global reserves, according to IMF data, but its share has gradually declined over the past 2 decades. Not dramatically, but directionally. That trend alone doesn't end dollar dominance. But direction matters. and sophisticated institutions position based on direction, not headlines. Now pause for a moment and think about what BlackRock actually represents. They manage pension money, retirement money, insurance money, long-duration capital that cannot afford systemic blind spots. When they diversify geographically, it is rarely emotional. It is risk management. That doesn't mean they are predicting collapse. It means they are pricing uncertainty, and uncertainty is increasing.
Here's where many people misunderstand capital flows. When institutions reduce exposure, they don't dump assets publicly. They rebalance quietly through allocation changes, new inflows directed elsewhere, slower reinvestment into specific regions. It's subtle. It doesn't trigger alarms. But over time, it shifts demand. Demand is what determines valuations. If incremental global capital growth starts flowing less toward U.S. assets and more toward alternative markets, even marginally, long-term pricing adjusts. That affects equity multiples. That affects bond yields. That affects currency stability. And eventually, it affects households, because mortgage rates are tied to Treasury yields. Retirement accounts are tied to equity valuations. Job growth is tied to capital investment decisions. So when we say America might matter less, we're not talking about decline in absolute terms. We're talking about relative weight in a multipolar financial system.
And that is a very different conversation. Historically, financial centers evolve. Spain led, then Amsterdam, then London, then New York. Each transition wasn't an overnight collapse. It was a gradual redistribution of influence. Capital followed growth, stability, and institutional strength. The United States still possesses enormous advantages: deep capital markets, rule of law, innovation ecosystems, military security. But markets don't operate on nostalgia. They operate on forward expectations, and expectations shift quietly. Here's a micro question that reveals the bigger issue. If global growth over the next 20 years is projected to come disproportionately from Asia and parts of the global south, where will incremental capital naturally flow? Institutions don't bet on yesterday's dominance. They allocate toward tomorrow's growth.
This doesn't mean U.S. markets are finished. It means concentration risk is being reassessed in a world where debt levels are high, geopolitical fragmentation is increasing, and supply chains are being restructured. Now let's connect this directly to you. If global capital becomes more geographically diversified, the United States may face slightly higher structural borrowing costs over time. Not because investors are fleeing, but because alternatives exist. Competition increases the cost of capital. Higher structural borrowing costs mean tighter fiscal space. Tighter fiscal space means more difficult budget trade-offs. And trade-offs ripple outward into taxation, spending priorities, and economic stability. But here's the key point. This is not a collapse narrative. It's a transition narrative. Transitions are slower, more complex, less dramatic, but they still change outcomes.
The smartest institutions in the world are preparing for a world where American financial dominance is less absolute and more contested. That's not unpatriotic, it's pragmatic. And when trillions reposition gradually, the system doesn't shake overnight. It adjusts. The question isn't whether BlackRock is leaving. The question is whether they see a world where diversification away from heavy U.S. concentration is simply rational. Because if that becomes the new baseline for global capital, then the implications stretch far beyond one portfolio adjustment. And that's what we're going to unpack next. Because here's where the mechanics start to matter. When large institutions gradually diversify away from heavy exposure to U.S. assets, even slightly, the immediate impact isn't visible. Markets don't collapse. The dollar doesn't suddenly fall apart. Instead, something more subtle happens. The marginal buyer changes.
And in financial markets, the marginal buyer sets the price. For decades, the United States benefited from structural demand for its debt. Foreign central banks accumulated treasuries as reserves. Global institutions treated U.S. bonds as the baseline safe asset. That steady demand kept borrowing costs relatively contained, even as debt levels expanded. But if global capital becomes more diversified, if fewer incremental dollars automatically flow into treasuries, then the math begins to shift. Not dramatically, gradually. The U.S. government currently runs persistent deficits. That means new debt must constantly be issued. If demand growth slows, yields have to adjust upward to attract buyers.
Higher yields mean higher interest costs. Higher interest costs mean larger deficits. Larger deficits mean more issuance. And that feedback loop becomes increasingly sensitive to shifts in global capital allocation. This is not speculation. It's mechanical.
According to the Congressional Budget Office, net interest spending is projected to rise significantly over the next decade under current policy assumptions. That projection assumes stable demand for U.S. debt, but demand dynamics are not static. They respond to relative opportunity. Now zoom out for a moment. If emerging markets grow faster than developed economies over the next 20 years, and if institutional risk models gradually increase allocation to those regions, then capital will naturally rebalance. Not because America failed, but because the world is expanding beyond a single center. And when the world expands, concentration premiums decline. Here's the key tension. The United States still has the deepest capital markets on Earth. It still benefits from reserve currency status. The dollar still represents the majority of global reserves according to IMF data. None of that disappears overnight. But reserve currency dominance is not binary.
It's proportional, and even small proportional shifts matter at scale. If the dollar's share of global reserves declines slowly over decades, the adjustment is manageable. If that shift accelerates during periods of fiscal strain or geopolitical fragmentation, the system becomes more volatile. Institutions like BlackRock don't wait for acceleration. They position ahead of it. That positioning is what you're seeing. Now let's connect this directly to your financial life. If borrowing costs remain structurally higher because global capital has more options, mortgage rates remain elevated longer. Corporate financing costs stay tight. Valuation multiples compress relative to the zero-rate era. Retirement portfolios that benefited from expanding price-to-earnings ratios during the last decade may not experience the same tailwinds going forward. That doesn't mean markets crash. It means returns normalize under different assumptions.
This is where many investors struggle psychologically. They expect the next 20 years to look like the last 20. But financial regimes shift, interest rate environments shift, capital flow patterns shift, and institutions adjust before households do. That gap between institutional positioning and household awareness is where volatility is born. Now here's the critical distinction. There's a difference between diversification and abandonment. BlackRock increasing exposure to infrastructure in Europe, private credit in Asia, or commodities globally does not mean they're exiting the United States. It means they're acknowledging that growth, risk, and opportunity are more distributed than they were 20 years ago. And that is a structural story, not a panic story. But structural stories reshape decades.
If the U.S. moves from being the overwhelming gravitational center of global capital to being one major center among several, then relative influence changes. Cost of capital changes. Policy flexibility changes. That's what people miss. It's not about collapse. It's about leverage. When your system depends on continuous external demand for your debt, your negotiating power is strongest when demand is unquestioned. When alternatives expand, leverage becomes shared. And shared leverage means discipline becomes more important. So the real takeaway isn't that BlackRock is predicting disaster. It's that they are pricing a world where the United States is still powerful, but no longer alone at the top. And markets always move before narratives catch up. So where does this actually lead?
There are really only three broad paths from here. Not predictions. Paths. And which one unfolds depends on growth, policy discipline, geopolitical stability, and global capital behavior over the next decade. The first path is the soft transition. In this scenario, the United States remains the dominant financial power, but its dominance becomes more shared. The dollar stays the primary reserve currency, but its share gradually declines in a stable way. Capital becomes more geographically diversified, yet U.S. markets continue to attract deep liquidity because of institutional strength and rule of law. Interest rates stabilize at higher than zero but manageable levels. Growth continues, though perhaps slower than the post-2008 liquidity era. Markets adjust expectations. Valuations normalize. There's no dramatic collapse, just a rebalancing of global influence. This is the most stable outcome. The second path is competitive multipolarity.
In this scenario,
global capital becomes more evenly distributed across multiple financial centers. The US, Europe, parts of Asia, and emerging markets all compete for capital flows. Reserve currency share fragments more noticeably. Bilateral trade agreements reduce dollar dependence incrementally. In this environment, borrowing costs remain structurally higher because demand is more competitive. Fiscal discipline becomes more important. Policy mistakes become more expensive. The United States still plays a leading role, but it is no longer the unquestioned center of gravity, and that changes how markets price risk. Then there is the third path, the stress acceleration scenario. This doesn't require collapse. It requires a trigger, a fiscal shock, a geopolitical escalation, a loss of confidence event.
If such a trigger occurs during a period of already high debt and rising interest costs, diversification trends could accelerate faster than expected. Capital moves quickly when confidence shifts, bond markets adjust rapidly, liquidity tightens, policy options narrow. This scenario is not inevitable, but it is why institutions hedge. Large asset managers do not position solely for base cases. They price tail risks. They prepare for volatility clusters. They allocate capital in ways that preserve flexibility if acceleration occurs. That's what risk management at scale looks like. Now bring this back to the central question. Does BlackRock's shift mean America is collapsing? No. Does it mean the era of automatic, unquestioned capital dominance may be evolving? Possibly, and that distinction is everything. Financial history shows that influence rarely disappears overnight. It redistributes, slowly at first, then more visibly.
The United States still has enormous structural advantages: innovation capacity, energy independence, deep financial markets, a strong institutional framework. Those advantages do not vanish because of portfolio diversification, but markets reward adaptability. If fiscal policy becomes more disciplined, if growth remains competitive, if institutional trust stays high, then diversification becomes a natural evolution rather than a warning sign. If not, pressure builds. And pressure in financial systems always reveals weak points over time. The important thing to understand is this: capital does not move based on emotion. It moves based on risk-adjusted return. If global risk-adjusted returns become more attractive outside the United States relative to inside, capital will adjust accordingly. Not because of ideology, not because of politics, because of math, and math compounds. That's why this story matters. It's not about fear. It's about direction.
If you are building wealth, managing retirement accounts, running a business, or planning long-term investments, you cannot assume that the financial structure of the past 20 years will automatically repeat. Diversification is not unpatriotic. It's prudent. Awareness is not pessimism. It's preparation. And understanding how global capital thinks gives you an edge that most retail investors never develop. So here's the real question for you. If the world is gradually becoming more multipolar financially, how should your portfolio reflect that reality? Should it remain concentrated in one geography, or should it evolve alongside global capital flows? Drop a comment below and tell me what you think. Do you see this as routine portfolio management or as a deeper structural signal? I read the comments, and your perspective shapes what we break down next.
If this analysis helped you see the bigger picture more clearly, share this video with someone who follows markets but hasn't looked at capital flows this way. And make sure you're subscribed, because in the next video, we're going to break down exactly how reserve currency share changes historically, slowly, mathematically, and what indicators signal when shifts accelerate. The world doesn't change all at once. It shifts gradually, then suddenly. And the people who thrive in those moments aren't the loudest, they're the most informed.